Well, let's start. We have a great honor tonight. So we were talking about Orange County. Y'all know I love these older cases because there's so much application. You think about Orange County at the time I was there, the sophisticated, large county obviously knows what they're doing, and then this thing blows up. Sounds real similar to AIG and the credit default swaps, or Silicon Valley and the balance sheet immunization and all that. And so while I was talking in class, John, just in the middle of my conversation, I go, oh, I remember there's someone at USA that the word just spread like wildfire. Someone at USA saw this coming before it happened. And I kind of thought it was either Bill Foley or John Bonnell, but I wasn't sure which. If it was Bill Foley, Bill Foley and I talked like maybe 3 seconds my entire career. But John and I got to know each other pretty well, saw each other in the hall. Nice guy, always joking with each other. So I thought, I bet he might be willing to talk about this. And he probably remembers it because you remember those big points in your career. And so it's a great honor to have John Bonnell here. He was at USA when it was part of USA, not Victory Capital, on the muni side. And so, John, I thought what we could do is just let you start, do a kind of stroll down memory lane of what you remember back from that period and how you saw it. Be as technical as you want to be, because I think they can handle it. So this is John Bonnell. So welcome, John Bonnell, to Risk Management.
Well, thank you, Ron, and thanks for the invite. And yes, I remember. Okay, you have to keep in mind I'm a lot older now than I was then, and this goes back to really, it was the spring of '94 when I took a trip out to Southern California, and this was just a routine, credit update, see what I could learn from 4 or 5 different muni bond issuers. And one of them was Orange County. And Orange County was the reason to take the trip because both the county and a lot of other issuers within the county, when I say other issuers, I'm talking about cities and school districts and other special districts that were located within Orange County, they were issuing all kinds of debt. I mean, every week they were issuing to the tunes of billions of dollars of very short-term notes for the sole purpose of putting them into the Orange County Treasurer's investment pool. And they were doing it because the rate that they were paying on their notes was lower than what they were earning in the investment pool. So it was a pure arbitrage for them. And you can imagine it raised a lot of questions in muni land. It's like, well, how can they do that? Because the IRS doesn't look favorably upon people arbitraging muni bonds. And a lot of these notes were taxable for exactly that reason. But we kept seeing them in the market. And again, the county was rated AA at the time. Most of the issuers in the county were very highly rated. This was a rapidly growing, very wealthy area. But we kept saying to ourselves, well, okay, how can they continue to earn this arbitrage? Wouldn't it just dilute the return from the investment pool the more new money they keep adding into it? And so we set up this trip to go talk to them. And the meeting was scheduled with Robert Citron, who was the county treasurer for 20 plus years before this happened. And literally, I was already in California. And the day before the meeting, I get a call from somebody in their office saying, I'm sorry, but Mr. Citron's not going to be in the office that day. However, the deputy treasurer, a guy named Matt Raby, would be more than happy to meet with you. And I said, well, I'm already here, so that's fine. And I met with Matt Raby, and we were just having a back and forth discussion about this. And he very haphazardly just throws out, he says, well, when I asked him the question about dilution and how does this work, he said, well, keep in mind that we do lever, the pool a little bit. And he just kept going as he said it. And I said, well, wait, go back a minute. What do you mean you lever the pool? And he didn't tell me the extent of how much they levered it, but he said that they buy very high quality securities that go into the pool. And with the leverage that they're able to create this arbitrage situation. And I thought, okay, it makes absolutely no sense to me that a county government would be doing such a thing. I mean, let's face it, county governments are there for public safety, overseeing education, roads, etc. They're not there to make arbitrage earnings in their investment pool. So when I got back to the office in San Antonio, we had several discussions about this. And we were all kind of rolling our eyes thinking, this just doesn't sound right. It doesn't seem like it's what they should be doing at all. But it wasn't until, and again, this was like in late March, it wasn't until sometime in April that a Wall Street Journal article came out, and it was quoting the guy that lost his bid for treasurer to Citron, a guy named Morlock, who actually ended up becoming the treasurer after the bankruptcy and everything blew up. But anyway, they quoted that this pool went from call it $7 billion up to 21 billion with leverage. And I thought, okay, that's 3x. So I called Matt Raby as I'm reading this article. I called Matt's office and I said, okay, this article, you mentioned leverage in the fund, but is it 3-to-1? And he said, well, yes, it went from 7 point whatever billion to call it 21 billion. And so my next question was, well, what happens to your pool if interest rates go up? And true statement, this one almost made me fall out of my chair. He said, well, he called him Bob, but Mr. Citron uses astrology to predict interest rates. And at first I thought he was kidding. And I said, okay, no. So really, seriously, what happens if interest rates go up? And he said, well, according to Mr. Citron, and we just don't think they're going up. I said, okay, but what if they do? And he couldn't give me an answer. He said, well, we would lose on some of our bets, essentially, that they put on. And again, in the back of my mind, I'm thinking, here's a county deputy treasurer who was an elected treasurer and had been there for 20 plus years, Citron, but he was not joking about the astrology and reading the skies to tell him which direction interest rates were going. And as you all know, I'm sure by now, the Fed raised rates, call it 300 basis points back then, and they lost their shirt. They had the county money and the other county entities that had money in this pool, which again was viewed like a money market fund. It was their bank account. Some of them, the public school districts, had no choice but to put all their excess cash in this pool. And so they had 7.6 billion that they levered up to 21 billion. And when it was all said and done, I think they lost $1.6 billion as lenders that were on the other side of these reverse repurchase agreements. The bonds that were in the pool, the securities that they invested in, were used as collateral and pledged as collateral. And so then they would pledge, call it $2 billion. They would loan them back $1.9 billion, and they would go out and buy another $1.9 billion of securities. And then they would pledge that again and borrow, $1.8 billion and change. And that's how they did it. And so when rates went against them in a very big way, and people started finding out about what was going on, everybody wanted their money back. I mean, think of any bank that has a potential run on it. It's a problem for them. And so the county, and not only the other side of the reverse repo agreements, but they had a lot of these notes that were coming due. They had other debt, et cetera, that they needed to pay, not to mention just their ongoing working capital, everyday cash needs that would be coming in and out of the pool. And so the county had really, according to them, had no choice but to file bankruptcy in December of '94. Thankfully, by then, we were out of all our Orange County exposure. We just didn't think it made any sense that they would be doing this. And as it turns out, it didn't. Ultimately, I mean, as you know, muni bankruptcies are very few and far between. But at the time, and I think actually even now, it still may be the largest muni bankruptcy ever. But it happened all because you had this county treasurer's office with very little oversight that levered up to invest long, even though all the people in the pool had very short, basically daily liquidity on their money. So you've heard of other banks and entities when they have runs on them, it creates problems. And when it's levered up, that problem is multiplied even more. So how about I stop there and see if you have any direct questions?
Yeah, I'm going to start with the student asked one to me last week, a really good question. So you walk into something and it's almost unbelievable, be that sophisticated. Your mind's probably thinking, I'm not understanding it. But you got to make a decision. So there's a career risk that you get out of this, and it ends up that it really wasn't a problem. But at what point do you say, hey, it's AA rated, but I think I'm smarter than the rating agencies. We got to get out of this bond. Do you worry that you're just missing it? Or at what point you say, it doesn't matter if I'm missing it or not, I don't understand it, we got to get out?
That's a great question. And I will tell you that there were many nights back then that I second guessed a lot of the ultimate conclusion, which was, hey, we need to get out of these things and avoid them for the exact reason you're saying. I mean, again, at the time, I was fairly new doing this stuff. And part of the reason for the trip was just to see what I could learn from these issuers. Because in my opinion, that's one of the best ways to learn. You can read an awful lot about it, but when you go sit down across from them and you just, watch their nonverbal cues and not necessarily what they're saying, but how they're saying it. And you just get a much better sense on, do I trust this person, or do I think that they're actually doing what they should be doing or not? And so back then I had many, many second guessing discussions, and Bill Foley was included in a lot of the talks that we had about it. The president of the firm at the time was Mickey Roth, and he wanted to just blast out, after the bankruptcy filing happened, he wanted to blast out, oh, we were all over this. And he did. He put a couple of ads out saying that, we completely avoided it, which triggered an awful lot of reporters and other people calling and asking the exact question that you just did, Ron. It's like, well, how did you guys see it when others didn't? And it's not that others didn't. It's just that we had a good group of people and a lot of back and forth discussion about it, and ultimately came to the right conclusion in that case. It could have gone on. I mean, it's kind of like if you go back to what comes to my mind first is the whole internet bubble, right? In 99. I mean, there were a lot of people calling for it, saying that this stuff is crazy. These companies aren't making any money, and yet the valuations are through the roof. But if you did that 2 or 3 years early and got out completely, I mean, you might have been out of business by the time it actually blew up. And so I guess all I can say is the takeaway is, just keep doing what you think is right, and ultimately you'll know. But if they did come up with some solution that stretched it out even farther and allowed them to get out of it, hey, we wouldn't be having this conversation, and my career wouldn't have taken the direction it did at the time either.
What do you think would have happened if the Fed if rates had just kept falling? You would have looked really, really wrong in 94, 95. I mean, he would have been making a bundle, right? If rates kept falling.
He was making.
How did you miss this, John?
He was making, but before the Fed did what they did, he was making literally 2, 3+ times what other county treasurers were making in their investment pool. I mean, it really should have been a huge red flag for everybody. And actually, after it all blew up in Orange County, because we had exposure in San Diego County too. And San Diego County is another one that I met with on this trip. And I knew that they were doing some of the same things, but it was nowhere to the extent that Orange County was. And when I say nowhere near the extent, instead of the 300% levered, it might have been 10, 15%. But they were, in terms of returns on county investment pools, they were like the number two, which there was a huge gap between Orange County and everybody else, but they were number two. And so we obviously had further discussions with them, because after the number one blows up, and you're thinking, well, okay, what San Diego County was doing was nowhere near as bad as Orange. Well, then when Orange falls off a cliff, you got to rethink, okay, how close are these guys? And another funny story, meeting set up in their office, and they called the morning of the meeting to say, hey, I know you have a meeting scheduled with whoever the treasurer was at the time. I don't even remember his name, but he's going to be in a meeting. If in the meeting, the topic of the meeting is the county investment pool. So if that's what you guys were going to talk about, why don't you just join the meeting? And I said, okay, I can do that. And I'm sitting there and I'm surrounded by the person next to me was the CFO of San Diego USD, which was another one that I had met with, because they were issuing a lot of these arbitrage notes for themselves too in San Diego County. And the first thing out of the county treasurer's mouth was, okay, I just want everybody in this room, and the room had to have, I don't know, 50 people in it. And it was like an auditorium style, similar to a lecture hall. And the first thing out of his mouth was, nobody can say anything to the press or any other discussions. What we're talking about here is private and confidential, because they were basically telling everybody that they could not withdraw their money, that in emergency situations, they would give them a certain percentage of what they had in it. But in order to prevent a run on the fund and go down a similar path potentially as Orange County, that they weren't going to allow it. And I'm a young buck at the time. I'm starting to like squirm and get a little lower in my seat, thinking, well, now what am I going to do? And as soon as leaving the meeting, I got on the phone and I called our compliance officer at USAA, because I'm thinking, all right, I didn't even know it was possible to get material non-public info in a state and local government setting, but there was a real question as to whether this was. So anyway, we did not trade out of any of the San Diego stuff, and they were able to keep people at bay in terms of not forcing a run on the fund and preventing the run. So that all worked out fine. But there was another one. I mean, San Diego County was a AA type credit as well.
John, I'm curious, this is early in your career. With Orange County, you're dealing with some really tough new securities. You mentioned repos, which I can't get my mind around. I haven't talked to those in a while. We talked about inverse floaters. How much of your job was having to figure out these securities, or did you just say they're too complicated to mess with, or did you have to sit down with a piece of paper and figure them out?
We tried to figure it out, but I'm a very simple native Texan myself. And so the stuff, if in my mind, if you couldn't figure it out, not only what they were doing, but why they were doing it, it just didn't make a lot of sense. And obviously in 2008, during the great financial crisis, there was such esoteric stuff being issued out there, whether it was, on the taxable side, the CDO type stuff, and then people would take it even a step further and have CDO squared or cubed. And I mean, when it gets to where it cannot be explained to a rational person, I personally would say just avoid it. That I'm sure some of it's perfectly fine, and for smarter minds than mine, they could figure it out and have it make sense. But the reality is there is no free lunch ever. If you're earning 2 and 3 times what others that are charged with doing something similar to you are earning, more than likely you're taking on some sort of risk. And if it's a risk you understand and are comfortable with, great. But if it's one that is just part of the black hole, like some of the stuff that the broker dealers do, that how do you possibly get your arms around all of it?
How do you think you early in your career discovered that you were in S&P and Moody's completely missed it?
Ron, I don't know. That would be more of a question to S&P and Moody's, I would think. I mean, there's always been discussions about, does it make sense that the rating agencies are paid by the issuers? Always makes you kind of wonder. And it's kind of like Morningstar that rates funds, et cetera. And it's interesting to me that if you look at, who they give their gold and silver medalist awards to, these people tend to advertise a lot with them as well. But all conspiracy theory, and I don't know. I mean, anybody who had asked the question, and certainly anyone who read the article that came out in the Wall Street Journal in April, should have seen it. Why they didn't act upon it or do anything about it is beyond me. I don't know.
I'll let students ask questions. If I can ask questions, all right.
You said Citron was using astrology to predict interest rates?
Yes. Yeah. And again, I never directly met with Citron. He canceled that meeting, and so I was talking to Matt Raby, who was his deputy treasurer. But Matt Raby's comment to me was that is how Robert Citron made his investment decisions, was using astrology. And I know, look, I know this is Orange County, California, Southern Cal, and maybe there's parts of that state that very much have a granola type culture, et cetera. But to believe that somebody in 1994, and apparently he had done this for a long time, and maybe he was successful at it, or maybe he just caught a long standing run of rates falling. But it's mind-boggling to me that in a modern era that anyone could have done what he did without more oversight, checks and balances, etc. It's crazy.
Why do you think because you said that the man you were talking to wasn't Citron. He had been in the industry for like 20 years, right?
Citron had been the county treasurer for 20 plus years.
And the man you were talking to, how long had he been in it? Because he was elected, right?
Citron was elected. Yes. Matt Raby. Say again?
The man you were talking to was chosen by Citron?
Yes. Yes. He was appointed. And I don't know if Citron picked him. I assume he did. Or maybe the county board. Yeah, I don't know. He was not an elected person, though, Matt Raby.
When you brought that back to USAA, what was the reaction to, they're using astrology to predict interest rates?
Same reaction that I had. They thought I was joking about it and just making it up. And I said, no, I'm not kidding. This is exactly what he said. And he was not kidding.
Was there an immediate reaction like, yeah, we're just going to get out? Or because it sounded like it took convincing.
It did. Yeah, no, it did. For the reason, the question that Ron, you were just asking, it's like, well, surely Moody's, S&P, other people that have some sort of oversight capacity know what he's doing. And I don't think a lot of people did, or if they did, they turned a blind eye to it because, again, this was happening at a time when anytime the state of California has a very volatile, revenue type structure to it. And it is because all the, the tech firms that are there and capital gains realized in great years end up being huge inflows in terms of state revenues. But the opposite happens too when we have recessions, et cetera. And so theirs was a very volatile budgeting situation. And anytime the state of California got into budgeting trouble and had, multi-billion-dollar budget gaps to address, they thought Citron was a hero because as a percent of revenues, if other county investment pools had interest income as 4 or 5% of their total revenues, Orange County had it more, like 5 times that, 15, 20%. And so every time the state ran into trouble, they would cut back county funding for this, that, or the other. And Orange County, very tax averse, conservative type area, they didn't want to pay higher taxes at all. And so they all loved him. And my guess is they one, either didn't understand it, 2, didn't know what he was doing, or 3, turned a blind eye because they didn't want to have to make the tough budget decisions that, their political, that the voters would not want.
Question is a question.
So you mentioned when you were having your conversations with them that you asked, hey, what happens if interest rates go up? And then obviously he said, we look at the stars. But what could he have said to maybe like change your mind on, oh, we don't need to sell off, or maybe like, was it like they're gonna diversify? Like, what do you think he could have probably said that would have made your mind be like, okay, we can stay here instead of selling?
Yeah, if he, well, and this is Mr. Sweet, this is a risk management class, correct?
Yeah.
Ron?
Yes, risk
Yes,
management.
okay. So if he had said, well, we have a risk management system that even though we're 300% levered, if we dropped, whatever, if we were down 200 million, well, that would trigger us to reverse out of these positions and to de-lever automatically. If they had some sort of process and system that would say, okay, when the early warning signs appeared, so if rates went up, I'm making this up, but 50 basis points, well, instead of being 300% levered, we're going to reduce that down to 200. And if they went up another 50, some process where along the way they're getting out of it, then I would have felt a lot better about it. Because again, I mean, this was a very wealthy county that had a lot of levers that they could pull. It's just that politically, the taxpayers didn't want to pay more taxes, and at some point, it's just the willingness of people to make tough decisions like that. But in this case, they didn't have anything. They didn't have any off ramp, if you will, to what they were putting on.
Yeah, and John, that's interesting because Greenspan was pretty methodical in raising rates. It wasn't like he went up 300 overnight. It was a pretty stair step. So it was a slow bleed that they could have gotten out of it. So.
Potentially they could have, but sorry, somebody saying something?
Oh, you're good. No, go ahead.
I was just going to say that yeah, I mean, if they basically what I heard in the meeting was, well, it can't happen. And we all know that nobody can predict things like that. And in fact, once it starts, does that mean, oh, this is a great buying opportunity because it's going to reverse back? Or is it going to be a series of rate hikes or rate decreases like we might be facing at some point here soon? But nobody knows. Nobody really knows. But as you go along, the answer wasn't satisfactory at all, in that there was no off ramp. And if anything, he implied that, well, if rates go up even higher, then maybe we'll put even more on. I mean, basically doubling down on what they had been doing. Crazy.
All right, John, I have one last question because I want to keep, this has been really fascinating, but this might be an off the wall question, but you hit this early in your careers. So what did you learn that you can teach these students about they start their careers about risk management as a newbie, walking in something you think is sophisticated, you don't understand it, which is probably intimidating. What did you learn in that process that, or maybe what do you wish you knew before you started the process, or what advice can you give these students about to start their careers?
I would say trust your instincts. I mean, do what you think is right and stick with it. A lot of people, I mean, even when I don't know if Ron told you, but I recently retired from, I was at Thornburg Investments, and when we were hiring analysts and younger folks, we really wanted the fresh set of eyes to come in and look at stuff with that different perspective or even lack of perspective, because the dilemma is, and what happens, and maybe this is what happened at Moody's and S&P, they just get kind of a groupthink going, and well, this is the way it's been done for years and it hasn't caused a problem, so it won't cause a problem going forward. But things change. And so to me, I guess just sticking to your gut feel, and you're not going to be right all the time. And we all make errors in judgment, but depending on what the ramifications of that error is, I mean, you don't want to bet the farm on it or, one's life on it. And so stick with what you think is right. And even if it's been done a different way for years and years, that doesn't mean it's the right way. And especially in a new environment.
Fascinating. Other questions? John, I really appreciate this. Is wonderful memory lane, Matt. We do have Arnas has a question. He put on a tie for you tonight, so.
So what was the point at which you were in that meeting, and maybe what was the internal dialogue that you had when you realized that USAA should get out of this position?
Well, the astrology thing, again, is kind of what pushed me off the end, but being as young in my career at the time as I was, I mean, again, it wasn't my sole call. It was going back to the group of folks at USAA and sitting down and having these discussions. My opinion was, this is crazy, and let's exit and get out and stay out. And theirs, I mean, they could have overruled it for sure. I mean, I wasn't the portfolio manager at the time, so Ken Willman could have said, yeah, no, you're out of your mind, and we're not going to do anything. But as it was, he heard the story and said, this is stupid for them to be doing it. And everybody was basically in agreement on it.
Yeah, and John, you had some strong personalities with Ken and Mickey, my word. That took some guts for you to even, stick to your grounds with those guys. Yeah. Wow.
Well, they agreed though, Ron. I mean, again, it wasn't like a brass knuckle discussion at all. When they heard it and they realized I wasn't kidding about the astrology thing and the amount of leverage that's actually, in fact, what they did, they all agreed that, yeah, this is nuts.
Interesting. Anybody else? Okay. Talia has a question.
Could they have used swaps to try to hedge any of the risk? Would that have helped? And since they're like a government entity, are they allowed to use derivatives, or is that kind of too risky?
Okay, I only heard part of that, but the part I heard was, could they have used swaps? Yes, they could have. And in fact, some of this, and the second part was derivatives. At the time, they were allowed to have derivatives, and which is why they had funky, not just your everyday plain Jane fixed rate securities in there, and then add on the leverage on top of that at 300%. The laws in California after what happened to Orange County and after the bankruptcy, the state legislature put guardrails around what they could do, which was good. And I'm sure that there's some forms of derivatives they could still use, but I don't think they are able to use any very odd, strange, exotic type structures, what I would call exotic structures. And they certainly can't lever 300% anymore.
Yeah, if they use swaps to hedge and actually reduce the risk, it would have killed the golden goose anyway. So they would have undone their whole spread business. But interesting. Anybody else? John, really appreciate it. This is, him volunteering his time. I'll probably ask him back next year. He's still willing. So thanks, John, very much. Really appreciate it. Very fascinating.
You bet. Good seeing y'all. See ya.
Bye. Let John get off there. That was great. Yeah, brings back. While he was talking, I'm thinking about that group of, I remember the politics and the people, and it takes some guts. I used to be in some of those meetings when I was more newbie than he was newbie, because I came over from the corporate finance side. He's younger than I am, but still, I came on the corporate finance side with less experience. And their comment about me was always, Ron's never bought a bond, he doesn't know what he's talking about. And so you're kind of like, you got to step in and say, hey, so it takes some guts. But you're going to be a newbie. You just got to, I always think what's the worst thing they can do to you is that's fire you. And sometimes that's like the best thing they can do to you and get you out of there. They can't torture you. They can't, well, maybe in some countries, but in the US, they can't torture you. So
even if rates still fell, would there really be any career risk on his end? If he didn't want to associate with the guy who did astrology for investing?
Well, I'll take the astrology away. So that's kind of gives them a strong case. But let's say that wasn't there, interest rates kept falling, and they get out of this bond. It's like what happened with me in '98. I'm like, man, this .com thing, this is crazy. I'm starting to short, I'm buying options, and it just doesn't work. IBM crushes that whole thing. I'm like, I'm so stupid. I stopped, and then 2 years later, I was right. 2 years early is, you look stupid. Y'all read The Big Short. The Big Short. If they'd done that in 2006, we wouldn't have a Big Short movie. It would be the Too Early Short movie. So you might be exactly right, but early. What's really frustrating, not only be exactly right, but early, but also be exactly right. And we're talking about it, and then it happens while you're talking about it. And and then you start second, why didn't we move? So you're going to have both those things. You move and it doesn't happen. You think you're stupid. Or you're talking about moving and it happens. You're like, why didn't we move? And so you would constantly check. And that's just part of the career. So he did the right. Well, first of all, call in the compliance officer. That's really good to do. You get information out, not be inside information. You call your lawyers first. Always to make sure. And USA had exceptional compliance. Stephanie, my word, she was. I was like, Stephanie, your job's keep me out of trouble. And she said, don't worry. I know when you do, I know when you breathe, I know everything you're doing. And she was really, really good. In fact, she was so good when she went to review entities we were doing business with, they were actually used her as a consultant to fix their processes because she was so good. So you start there. But yeah, your entire career is career risk. With me, with Bob Davis, people used to call me, why hasn't he fired you yet? Because he would scream at me so much, but he wasn't screaming at me, he was screaming because of the news I was bringing him. And the people he was firing were ones that weren't bringing him bad news. So sometimes you take the risk and it's actually the right thing. Sometimes you take the risk, it's the wrong thing, they fire you. What do? You start your career over again and you're fine. So I've never been fired, but I know a lot of people I have that are, doing quite well today. So stick to what you believe. But yeah, it's fascinating. If you find stuff like that boring, you probably shouldn't be on the investment side because that's what we do, Arnis.
Speaking of career risk, this is a bit of a tangent, but on a more personal level, like in terms of investing, what we're doing, take on a lot of risk. to capture all the exciting stuff because, you have a lot more time. Would you say the same thing applies with career risk? So take large career risks early on in terms of like figuring out a job and, you can get fired earlier.
Yeah, there's a great book. I can't remember the name of it, but it talks about some of the best traders and every single one of the stories, this chapter to chapter, the huge mistakes they made early. And part of that, there's two sides of it. The huge mistake they made early, so they learned a lot. You can look at Soros and some of the others. The other is like a Warren Buffett, you take a huge risk early and you're right. It sets you up as this genius that things just become easier. So there's one side of it, you take big risks early because you can't lose as much. You got your 5,000 invested, big deal. You won't notice that 50 years later, and you're almost better off losing it. So you learn it then than losing it when you got 5 million. But the other side is if you are successful, it really does open up doors as long as you're smart enough and humble enough to know that a lot of that was luck and you're gonna, be real careful. So it can go both directions. So like I said, your biggest black swans, and that may be why your biggest black swan is going to happen in the next 5 years. So I talked to 2 alums today. Really, really interesting. One of them's one of our star football players. Man, he had the perfect finance job. He quit it and started his own business. And it's really fascinating what he's doing. That's a pretty big career. The other one has a great career, interesting, but he's got 2 businesses he and his wife are starting, or fiance is starting on the side. Really interesting. A lot more guts than I have. I somewhat played it safe, but yeah, I think the biggest risk is that you don't take any risk. You play it so safe, especially when they offer you the job that you don't think you can do, and you say no. That's going to be your biggest mistake. Even if you take it and you get fired, you're still better off taking that risk. I can't think of a decision like that I made that I regretted later. So yeah, you should take, but not just when you should be taking those risks your whole life, Although I have to say I'm not taking many risks today, but so I'm kind of tired and old. But Sebastian.
So you mentioned, you were talking about the big short. Was there a way somebody could short like Orange County, or is that?
It's hard to sort muni bonds. That's a pretty tough one. There are muni bond funds that would have Orange County in it, but it wouldn't be more than 5% of the portfolio. It's tough. You can sort treasuries. You can sort some corporates. John might know the answer to this. I doubt there's much of a market for sorting municipals. It's a somewhat of an over-the-counter type of market. It's a little less liquid than even corporates.
Said that those, maybe didn't have the tax advantage. I thought that was.
Well, it's the IRS has a thing called non-business income. So I have that with my charities. So when the IRS looks, it says, you have this charity, you got this income. So we have this big portfolio. They're worried that your entire charity is set up just so you can make much investment income and shield it from taxes. So they want to know, what are you up to? So Orange County wasn't in the business of making investment returns. It was supposed to be picking up trash. And so that's that other business income. You come to some point where the IRS says, this whole thing's a sham. You're not really a tax exempt muni. And so they can somewhat shut you down. So, is the IRS going to come in and do that? It's possible. Yeah.
So why invest on that? If they don't have the tax advantage versus investment.
No, he was implying that could happen, that they were doing things that the tax law wasn't set up to give them that advantage. And the IRS can step in and certainly make that. Right now, we're having that issue with Harvard, right? The president's somewhat threatening Harvard and say, hey, you're not a not-for-profit. We're going to tax you. So yeah, the federal government can change the tax laws at any time. And if you're doing stuff like Orange County, it's pretty incredible what he did, right? He's making a lot of money. Why? Borrowing short and investing long in a money market account. Makes, John's going, this makes no sense. As a would y'all figure this out? Get right out of school? He was not quite right out of school, but it takes some guts to say, I think it takes a lot of guts in your 20s to say, this doesn't make sense to me, and I'm going to tell everybody around me that it doesn't make sense. Usually what do we do? This doesn't make sense to me, but I'm going to pretend like I understand it. That's what most of us do, and that's the bigger crime. So yeah, fascinating stuff. Yeah, I love this stuff. It always makes me want to go back those years. John was a great guy to work with. A lot of fun. There was great people in your network as you go through your career. You're going to be building up these. So I haven't talked to John probably in 10 years, but You know, all I gotta do is call him and say, yeah, I'll come talk to your class. So that's your network that you can have. I doubt he'll call me to talk to anybody he knows, because, you know, he's a bond guy and I'm an equity guy, but yeah, interesting stuff. All right, let's finishing up long-term capital where they finish themselves. So great start, doing extremely well, right in the middle of this Orange County, which is the reason I like putting these two together. Bond market's blowing up and this hedge fund starting and has two great years and starts off really strong. It's completely unknown in the US. It's this hedge fund that's just off the chart, off the books. No one knows about it. And yet it's because of all this leverage, it's as big as Merrill Lynch that everybody does know about. Their opportunities are getting smaller. Sounds a lot like Orange County. They're desperate for more earnings. So what do? You lever up, you do more leverage. So if before you're getting 12 basis point spreads, and now you're getting 6 basis point spreads, you got to double your leverage to keep your returns where they are. So you got to double your risk. So the opportunities are diminishing. So one thing to do is lever up by returning money to their investors. I think Renaissance Capital did the same thing, but without the blow up. So you know what? We'll just invest our own money and we'll just lever it up. We don't really need your money. Here, take it back. You probably don't know that firms do that. You think, hey, we want this management fee, but long-term capital management said, no, we don't need your money. We're making enough money for ourselves. So that just levered them up more. They're returning the equity to their investors and they're sweeping the capital and they're just leveraging up, not 10 to 1, more like 30 to 1 or more, 50 to 1. So they say, okay, we can't get the spreads here, so let's go to other markets. And surely our models will work just as well in the Russian debt market as it works in this market. So let's just go to other places. They trusted their models and they're going to take those models wherever. So we talked about some of these things: risk arbitrage, market neutral strategies, shorting, equity volatility, which is essentially selling the VIX, M&A arb. They were making actual directional bets. I don't think they were using astrology, but they were definitely using some pretty sophisticated math. They started getting emerging market debt. Remember, they were buying big spreads and shorting narrow spreads. And where's the biggest spreads you can find? Emerging countries. Now think about this: Russia in 1997. It's only been the wall has only fallen like, you know, for 10 years. Russia is a very young country. Now, I don't know if Yeltsin's president now. Y'all don't remember all this stuff. We were amazed. You guys, oh man, you can't even imagine. I come out of high school and USSR is going to be on our back for the rest of our lives. We're going to be thinking about nuclear war the rest of our lives. And I remember coming to USAA one day and I go, my good friend, Brian, did you see what happened in Hungary yesterday? It's like, what's going on? Hungary is now separating from the Soviet Union. Completely blew our minds. And then, you know, Gorbachev, y'all know any of these names? They don't even mean anything. Y'all know Gorbachev? I mean, not personally. Y'all heard of Gorbachev and Yeltsin. And then obviously Putin kind of messed it all up. But, you know, we're thinking this is incredible, but it's just the start. We don't really know how this thing's going to work out. And here's a firm that's going to bet on Russia. And they even started a Bermuda-based reinsurance subsidiary, which makes no sense to me at all. We talked about that in my P&C class. I don't even know how they had any expertise in that area. So they're trying to find money any place they can play because they got to make these big returns, keep justifying their investment returns, getting in places they had no expertise, and they didn't have an information advantage. I know you think about today where you can just go onto the internet and go to Bloomberg and you dump thousands of pieces of data just like that. That wasn't true at this time. There wasn't that kind of data out there, especially on the internet. This whole idea of people sticking everything they have on the internet. Back then, there wasn't that much stuff out on the internet, especially massive files of data, because the internet didn't have the bandwidth to do it. I mean, it's, you know, talk to your grandparents. I'm trying to remember how old I am. Talk to your grandparents. You know, you want to watch a movie and say, yeah, I'm downloading a movie. I think I can watch it next Thursday. It's you know, it's coming in 1%, 2%. We just didn't have the bandwidth for that kind of data. So where are they actually getting this? Where do you get the data on Russia? Russian spreads. It really doesn't exist. So they're essentially just going in blind on this. And then we had the Russian debt crisis. So they had a bad month. Remember, they're having trouble losing 1%. On this fund making 57% in a year, they couldn't have a 1% down month. And then they had a 6.7% down month. So, okay, whoops, what's going on? Well, that's just a one-time thing. Credit spreads continue to widen. Remember, they're betting on them narrowing. And where do they widen? Every place long-term capital management was. Why? Because they were the market. They didn't have any buyers and everybody was fleeing. They knew something was going on. The stock market implied volatility rose to 27%. They shorted it when it hit 19, which is a pretty low level. So they thought, wow, 19 is high, let's short it. Remember in 87, it hit 100%. So they're thinking 19 is the high end. And here it hits, now 27 doesn't sound that high to us, right? Remember it hit 50 just a few weeks ago on Liberation Day. So 19 is not that high. In June, they had a 10% down. So obviously things are happening. Look at this chart. Well, I'll show you this chart in a second. So Solomon, remember Solomon? This is where Meriwether came from. Solomon's really their only really big competitor. Solomon says we're out. They start liquidating. What happens when you have two big owners of assets and one of them starts selling everything? Who's the buyer? You know, that's not good. So Solomon's essentially shorting long-term capital management. So liquidity is a big issue here. Russia and Asia, they firstly piled into treasuries. So everybody's buying treasuries. That's called a flight to quality. When everybody's buying, what was long-term capital management shorting? They're shorting treasuries and buying risky assets. What's the world doing? They're selling risky assets and buying treasuries. It's like the worst possible story for them. So what did long-term capital management do? They just kept doubling down. So they're saying, surely we can't be wrong. A lot like Robert Citron, we can't be wrong. Interest rates are now even more in our favor. If we're doing this thing back in January, we should even do more of it now in April and May. Look, it's more in our favor. They can only narrow at this point. The VIX can only go down from this point. What happens when your boss says this? That's the only thing that can happen. The easiest thing to do is say, well, and this is the most amazing thing. When people say this could never happen, you say, well, it happened 3 years ago. It happened 7 years ago. So it can happen. So a lot of times you don't have to go very far back in history. When someone says this can never happen, and show them, yeah, it happened not that long ago. You may want to say it quietly if you're the newbie. You may want to do it as a question, more like, don't say, yeah, but it happened then. To say, well, how's that different than what happened? And, ask it as a question to kind of give your boss a chance to get out. So they doubled down more heavily in the Russian bonds. So they went all out in Russia. So they bet on risk everywhere. In every place, they own the riskier asset. They were short the safer asset, and that was the worst trade. So we had Russia declared a debt moratorium. Now this is really interesting because you remember with my pension plan, the swap spreads saved us. Swap spreads narrowed when corporate spreads widened. We were using corporate spreads to price our liability, and we had our swap and swap, so we actually benefited. But if this had been our case with our pension plan, we would have gotten hurt because swap spreads jumped out to some of their widest. Now, how low can swap spreads get? So what's a spread? First of all, spread is over what? What's your base? Treasuries. So can swap spreads go below treasuries? You wouldn't think so, but they have. Swaps have negative spreads. One of our alums was pointing out, people say, well, swaps have all this collateral, and the federal government was talking about not paying their debt. So maybe swaps could be lower risk. And one of our alums pointed out, yeah, but most swaps, their collateral is treasury bonds. So if you're worried about treasuries, then why would something that has treasury bonds as collateral be safer than the treasury bonds? But man, 76 bips on swaps, that's really, really unheard of. That's pretty crazy. So August was the worst, and that probably the worst we've ever seen on swap spreads, not the worst we've seen on credit spreads. Certainly 2008 was much worsened. And here's my point. We've never seen anything like that before, although it did happen 10 years ago, 5 years ago. So partners noticed an ominous pattern. Every one of their trades were falling more than others. Essentially, people were getting on, kind of latching on the long-term capital management was the entity in trouble, which means whatever they had would fall. I think Lehman Brothers somewhat experienced the same thing. Some of the other investment banks, whatever they have, we want to avoid it, which just made the problem much, much worse. So here's VAR, all right? They did do VAR. If you'd done VAR, if I had worked for Robert Citron right out of this class, the first thing I would have done would be calculate a value at risk. And I would have say, hey, rates rise. And then I would have gone back in history, say, yeah, and this year they rose this much, and this year they rose. It is possible they can rise this much, and we would lose this much. I would have done that. So they were doing VAR, so they're doing exactly right. They're far more sophisticated than Citron. How good were those VAR models? So let's say this is a 1% risk. What's the chance they could lose 50 million in a day? It could happen, right? 0.5% at a time, 0.2%. What's the chance they could lose 75 million in a day? That should be pretty unheard of. So here's their actual losses. You notice I changed the scale. Look at the top of that scale. Here's their actual daily losses. What's the chance, if you believe in the stats here, what's the chances of that happening? Mathematically impossible. Could not happen. So was this a 1 in a trillion to the trillionth power risk? Or was this number miscalculated? Which of those two you think is more likely to be the case? You look at a day like this, they would have said, wow, we had a really bad day, but in comparison, it doesn't look all that bad. And they had another year. And look at this. This isn't like 94, 98, 2003. No, this is August 21, September. These are 1 in a trillion to the trillionth power events, and we had 2 or 3 of them in a 1 month period. So either our math is wrong, or this was something so incredibly crazy that, it just boggles the mind that it could happen. So they was taken over by 14 banks. It was interesting. Peter Fisher was the Fed guy who took care of this. He got a lot of flack for this, but there was no government money put into this. He simply got the banks together. He went and worked for BlackRock. We had money with BlackRock, and so BlackRock invited me to Austin for a luncheon that Peter Fisher was going to be at, and I said, yeah, I'll go. So I went, and I have this knack. It's not like I push myself in, but I always get to sit next to the famous person. I think it's because I'm so quiet. I just kind of sneak in, so I can sit next to him. Unfortunately, some of y'all heard this story before, but unfortunately, someone told me, Ron, your car is parked in a tow zone. So I run out, and running out, I trip and I slide, and I take all the skin off my arms. When I come back in, I'm just blood everywhere. And people were like, what happened to you? But I still sat next to Peter Fisher. He was probably a little concerned about what's with this guy. But yeah, I was bleeding everywhere. I couldn't hide it, but very interesting. I had read Lowenstein's book, which is what this presentation comes from. Lowenstein is quite negative on Peter Fisher, so I didn't bring up Lowenstein's name at all at the lunch. I didn't mention that I'd read that book. BlackRock hired Fisher. I could tell. I'll probably put this on video and get in trouble. I don't know if Peter, I can look up and see if Peter Fisher is still alive. I think BlackRock hired Peter Fisher because it was Peter Fisher. He was just someone that could take around to clients and introduce. I don't think he was a decision maker, but it was pretty cool meeting him. Very interesting. He did talk. I definitely brought up long-term capital management. Heard him talk about it. He was very proud that this whole thing got worked out without a major domino effect. This is 98. This doesn't cause a 2000 crisis. This was actually resolved fairly well, mainly because there weren't that many investors in this. This wasn't something the retail investor had. So the banks had a problem because they had loaned so much money. And one of the debates they had was Citibank. Citibank had a letter of credit with long-term capital management. And it was a committed line of credit. So when you have a committed line of credit, you're getting paid money to loan them money. So when they ask to loan money, you had to give them money, but you had an out. If there was some material condition change, you didn't have to loan them money. And so what the Fed told Citibank, you have a commitment to loan them money. You could take an out by the contract, but if you take the out of the contract and that causes them to go insolvent and that causes this domino effect, and then people come in and sue and say you didn't have the right to take them out, to void that loan, you could be really sued pretty horribly. So they were, it was a scare tactic. Are you absolutely sure you're reading that clause in the contract correctly? And so Citibank eventually said, okay, we'll jump in and be part of this. And so Peter Visser got all these banks together to work out this situation. It worked out. Some of this, it helped that the crisis ended fairly quickly as well. And so the fund kind of came out on the other side. No public money was involved. The Fed was on the defensive. Some people are arguing the Fed should have stayed out and let these people lose money so they learn if they don't, have y'all heard the term, the Greenspan put, the Bernanke put? Y'all heard those terms, right? Fed steps in, acts like a put option to cover your losses so you can't lose more. And that was somewhat, people were talking about the Fisher put, Fisher coming in, but did not, unlike 2008, did not commit public money to this. So thanks to the rescue, they met all their margin calls. Everything was repaid in full. Unlike what we saw with MG, what we saw with Orange County, where they had the ability, because they had so few investors and their investors simply had to just sit there and wait for their money, let it turn around. They did have the patience to let this work out, but it would not have worked out if Fisher hadn't gotten these banks to cooperate and provide enough funding to get them through. It's back to what we talked about on liquidity risk. Was this a liquidity crisis or a solvency crisis? And they treated it as a liquidity crisis. If we can just get long-term capital management, the cash to meet their calls, the markets will settle down, the assets will come back. And so they didn't make money. They kind of avoided the fault with the people who had, the capital. They lost their capital, but all the creditors got paid off. Fisher was worried about the domino effect of the banks. Because what these banks discovered, and we'll see this, was each one of them thought they were the biggest lender to long-term capital management. Like, we're the big guys. We're the ones giving them $5 billion. And then when they all got together, they're like, oh, we're all doing that. This is huge. It's not just one entity. And so they were somewhat shocked, and they kind of had to step in to avoid the domino. And then it was liquidated kind of quietly. It was big news in finance, but outside of finance, I don't think a lot of people really noticed. So it kind of worked out. It's hard for me to criticize Fisher given how much worse it could have been. Why did the long-term capital management people say? They said it was the market's fault. The markets were irrational. That's true. They were the victims of outside events. Liquidity shortage in August, followed by hostile front running in September. Front running, that people were essentially figuring out what long-term capital management do and just do the opposite that caused the trades to mess up. So we may not be able to finish this. Here's the lessons learned from this. There's so much in this that applies today to what's going on. First of all, can you really measure risk? So what's the difference between risk and uncertainty? Let's kind of get into that one. Risk is a game of dice or flipping coins. If I flip a coin 1,000 times, how many heads would I get percentage-wise? Somewhere between 49.9 and 50.1%. If I flip a coin 1,000 times and I get 200 heads and 800 tails, what would you say? Someone's cheating, wouldn't you? Would it be obvious I was cheating, or say, wow, that's kind of freaky? I mean, you saw that $600 million daily loss compared to the VAR. That would be like me flipping a coin 1,000 times and getting 100 heads and 900 tails. You can say there's something wrong with the coin, right? So flipping a coin is very, very different than buying a piece of a security or these other things, because that's uncertainty. Uncertainty, you bring the human side of it into it. So investing can broach both risk and uncertainty. Long-term capital management had a healthy knowledge of risk. It thought it put probabilities on everything, just like you do with coin toss and dice tossing, but that doesn't work when you have humans involved. So one key thing I think is really important, we talked about this early in class, when you're flipping a coin, each coin flip is independent of the previous ones, but that's not true in investing. What happens today influences what we do tomorrow. So it changes the present and the past changes the future. So they're not independent events. They influence each other. So you really can't do it with that kind of statistics. Markets have memories. So this kind of, let's bring the mathematicians and the finance, and they'll take over and rule the world. Fortunately, it didn't work because finance isn't as precise as these mathematicians thought. Correlations in a crisis. This one's pretty obvious. We've talked about this before. When you have a crisis, correlations all move to 1 except for treasuries. Correlations move to -1. Happens over and over again, and we forget it. And we're so shocked that it happened, even though it happened 10 years ago. So everybody's fleeing the risky stuff, buying the low risk stuff. So Merton said, no, that can't happen, even though it had happened. Part of this was liquidity and the correlation are combined. We talked about that as well. Liquidity and correlation are very, very important because when you get into the crisis, things that were very liquid 2 years ago are now extremely illiquid. Why? Remember that important thing. Where's the next crisis? Your next crisis is it's going to be whatever your most crowded trade is today, whether that's Bitcoins or I don't know if I can think of what's the most crowded trade today. It was the MAGA 7 last year, last few years. Your most crowded trade becomes your next crisis because that's going to be your biggest buys are now going to be your biggest sells when the thing turns around. So there's a lot of Doug Hubbard in this talking about the contagion effect. When you get into the tails, everything changes. You can remember that in your career. When you look at the normal curve, everything looks fine, and the world does follow in the normal curve really well until you hit that 1% or whatever event. When you get into the tail, things unwind in ways completely unexpected. So what about liquidity? They assumed they could get their trades done, but there was no liquidity in credit markets. We see this, and you're going to see this in your career. Credit markets dry up about every 5 to 10 years in massive ways that are so shocking. Now, 2008 was an extreme, but we've seen other events like that where the markets people will not buy until they figure out what's going on. We're somewhat maybe seeing that a little bit with the tariff going on now, and people are uncertain about what's going on, and people say, I'm just going to sit on the sideline. So liquidity dries up. So it's hard to predict when those things are going to happen and which markets are going to hit. So when you need the money the most, that's when your sources are less likely to loan to you. So long-term capital management, similar to what Orange County was doing, they had some of the most complex trades, the hardest ones to get out in that crisis, and yeah, just disaster. Too much debt. We'll talk about this on Thursday. I'll mention it now. How do you make yourself fragile in your 20s? You can kind of guess. What's the number one thing you can do to make yourself fragile in your 20s? Borrow money. And I'm not quoting Dave Ramsey. I'm not a huge Dave Ramsey fan, but I do agree with him. Debt, you should avoid debt as much as you possibly can in your life. There's nothing that makes you more fragile than leverage, than debt. We saw that with Orange County. You're seeing that with long-term capital management. Debt is a killer of flexibility. And then the bigger you are, the bigger the liquidity price is going to be. Long-term capital management is massive, which means liquidity was going to hit them more than anyone else. One wrong day and you're out of business. Lehman saw this. If you think about Lehman Brothers, I don't know if y'all heard of Lehman Brothers. I don't know why Brothers is on there. You were questioning about Solomon Brothers. It's like, why do they put brothers on there? Are they actually 2 brothers that got together, or 3 brothers? I don't know. And 2 Lehmans that got together. But Lehman Brothers, they were perfectly fine as long as the market would loan to them, but all that their funding was short term. So they had to go to the market constantly. And it worked, and it worked, and it worked, and it worked until when? until it didn't. And on one Monday, it stopped working. And when that stops working, you're done for. It doesn't matter what you say. You can try to convince markets everything's fine. But one day is all it takes when liquidity is your only source of survival. So when you're dealing with markets and you're dealing with models, how good of a job can quantitative finance do? This is kind of my question we'll talk on Thursday with AI. AI is pretty precise with this quantitative models as well. I don't know how AI is going to handle these massive tail events and the contagion, how it's going to understand them. It'd be interesting to see. So how much do you trust your models? Remember that quote I said is, models are not insight. Your model's not going to teach you something. Why? Because you built the model. You told the model what to believe. It's really unlikely you're going to tell the model what to believe and now it's going to teach you something. That's going to be pretty unlikely. It's going to kind of spill back what you said it to believe. So markets aren't that predictable. Fat tails, remember fat tails, bring that up in an interview. Fat tails are a lot fatter and they keep happening to us over and over again. So Russia, especially, how could you possibly think you're going to understand Russia? Yeah, and again, a lot of these things were not that unpredictable. Traders are not random. They react in ways that are completely unpredictable. There have been studies, I might show you an article on Thursday. They're having articles of using drugs to try to get traders to not react like this. And it creates problems on the other side. We're humans and we're going to do stupid things. We'll see how AI does. Concentration, having too much in one name. You assume you're the biggest and you discover you're not. And you know this. So even Scholes, he started protesting that some of their positions were just way too large. And we talk about, Solomon Brothers having too large a position in one asset. Concentration huge. Scholes was deeply upset by these trades because he argued that they didn't have any information on advantage and they were taking small amounts of information and assuming that these markets were going to be the same as the other markets they studied and then be terribly surprised. For many such losses to occur is what deters most other people in the industry from taking imprudent risks. So this was the argument against the Fed. Let them fail miserably, let everybody else learn from their mistakes. That's what some people argued for 2008. Let AIG fail, let General Motors fail, let all these entities fail. If you're the one making decisions, what you're thinking is if they fail, what's going to come next? This interconnectionness. So I can kind of understand their side of it. These things especially happen after you've had several years of good news. We tend to get complacent. And it's very similar to what John is talking about is, they've been doing these leveraged trades and they've been working. And the fact they've been working, you keep doing them, you just kind of get complacent, they're going to work. And then you start asking, well, what if you're wrong? What if interest rates change? So the Fed's involvement could have been a good learning experience that might have prevented 2000 from happening or 2008 from happening. My guess is it wouldn't because we tend to have very short memories, as I'll show you. I hate this quote because the amazing thing about this quote is who said it, but I have one problem, and you want to guess what that one problem is? I forgot to write down who said it, but it's an amazing quote. The authors concluded that the hedge fund industry has been dramatically underestimating the correlation of its returns to the lower overall stock market. Hedge funds as a class have never been more popular or more vividly sold fantasy. So you might think that this was said before long-term capital blew up, but it was actually said several years after. So it didn't take long for them to forget long-term capital management and start doing the same stuff again. We don't really learn from our. So you're asking, why am I doing such these old cases? Because we keep forgetting these lessons that are really quite powerful and we shouldn't forget them. So here's some quotes. Life is a trap for logicians because it's almost statistical. It's almost sensible. It looks mathematical than it really is. its exactitude is obvious, but its inexactitude is hidden. Its wildness lies in wait. It's eventually gonna hit you. And then Mark Twain, history rhymes, it doesn't repeat. So, there's, this is the other quote. I don't know who said this, so we'll stop there. All right, so on Thursday, we'll talk about the exam, and then I have some final thoughts on risk to show you, and we'll stop there. On your projects, I'll start looking at them again. I was gonna do it today, but had some other stuff to catch up on, but I'll probably work on them really hard tomorrow afternoon. And then I have a class I got to grade this weekend. I put the outline of the project out there because I know the videos are a little bit different. So I show one in class, went through it. So make sure you read the project outline. It shows you everything you're supposed to do. Some had confusion on exactly what had to go into the manager attribution. So that's in there. So that's out there on their files for projects. So, so I'll hopefully get those back to you pretty soon. Some students really struggle with it. So my defense, y'all may not like this defense. My defense, if it was the professor's fault, then why did a couple of students make 100 on the project? So maybe they're just a lot smarter than the professor and figured it out on their own. But so some people figured it out. So I think part of it, and we'll talk about it, I think part of it is procrastination, not the pointing fingers, but I do think some students start way too late and then it's this rush and they just miss stuff. So it's I think a really good project. It's actually, this is the one of the alums I talked to says, you should do this in your class. And yeah, we do. This is my risk management class. So any questions on that? It does help if you make major changes, at least tell me where you made the changes. If you changed everything, then y'all just have to grade the whole thing again. There's a couple I'm gonna have to do that. But if you made a specific change, tell me where it was or highlight the change. I'm just me grading like a wild man this weekend and next week. All right, let me get Andrew. I think I got everybody. Cole, Dante, Jonathan, Hiram, Derek, Daniel, Aaliyah, Alyssa, Mindy, Mohammed. All right, I don't think anybody else. Batman. This is Marcelo. Oh, Andrew, you're way back there. All right. So what we're going to do tonight is we're going to look at the exam, get ready for the exam, and then I'm going to finish up the class with, I think, some really good topics. One of them is my idea of risk management on the personal level, and I somewhat tested it tonight because I was talking to an alum, and I didn't tell her what I was going to tell y'all, but she kept saying what I was going to tell y'all. How do you do good risk management in your career, in your life? So I'll share some of that. Here's the exam. So the first one, pick one of those major risks: interest rate risk, price risk, or credit risk. The model is going to be define, measure, mitigate. So don't get skimpy. Put not just what's in the class notes, but what we talked about in the lecture. So go find the lecture where we talked about that. I did a pretty good job of listing in the videos what was in each one of those risks. Make sure the one on the bigger risk is a longer discussion than the one on the smaller risk. Any question on number one? People are asking, what does the 15 minutes mean? First of all, if we did the paper in class, you'd want to assign about 15 minutes. I'm using the CFA approach. The CFA exam's in minutes. And if a question is 15 minutes, then it's 15 divided by 75 as part of the exam, as far as its weight. And the CFA minutes are actually pretty important because if you get behind, you're in trouble. I left the third part. I studied so hard, but I left the third part not knowing if I passed because there was a swap question. How much better could it be? A swap question. But guess what kind of swap it was? It wasn't an interest rate swap. It was a currency swap, what I hate more than anything in the world. And literally my answer was 1, 2, 3, struck it out, wrote the exact opposite, struck it out, wrote the exact opposite. I did like 4 or 5 times. A 30-minute question took me well over an hour. And so the very last part of the exam, I was just flying. And so I didn't know how I did because I was going so fast in the end. So, but here you don't have to worry about this because you're going to submit it in advance, but it's 15 of the 75 minutes. The second question I think is pretty easy. You're essentially summarizing my blog in your own words. I give you an outline of it, but that's an outline of my blog. And you should watch the lectures, videos. It's not the entire lectures. Remember, that's the class I forgot to record. So you're actually watching a video from a previous class. But if you go back to our YouTube channel, classes 15 through I think it starts in 15, 16 continues it, but then the end of the class is talking about the risk paper, the bank paper. So it's not the entire class. And then the first part of 17. So there's probably, an hour and a half, 2 hours worth of videos. And then you have the blog, and on Zoom, you do have the actual under price risk. You do have the PowerPoint as well. So if you want to copy some of those graphs in, you can do that as well. So it's all out there. This is where I really get confused with students who give me really like 2-sentence answers. It's like, it took me 3 classes to go through this. It should take you more than 15 minutes while you're on Facebook to do it. So why do I want such intense answers? Because you're not going to succeed in finance knowing surface things. I know there's this perception that Elon Musk is going to give us chips we can put in our brain and we know everything immediately, but that's probably another 20 years out. So you actually have to know. One thing I don't think finance majors realize, that the career you're going into, unlike a lot of careers, is that they pay you for what you know. They don't pay you for what you can look up. They pay you for what you know. I love that about finance, because I love learning stuff. I was just talking to Krissa, and it's amazing what she knows now. She's an expert in her field. I'll show you her promotion that she's got, even though she's very, very young. And that was what she's telling me. I mean, I'm so glad I kept learning. So I want you to prove that you understand this topic. So hopefully you've already got a good draft on it. The next section, you get to choose either a case study or the great thinkers. And on the case studies, you only have to pick one of those. So we had what Ahmad talked about, which is maybe the simplest one, because he essentially summarized what he talked about if you're here, and his video is out there. Orange County is pretty exciting because I gave you a lot of extra stuff with John Bonnell. He said, man, I should have come in and talked. And so next year, he's going to come in and talk to his class. Did y'all enjoy his talk? He's kind of someone knows what he's doing. He's retired now. So we talked about these other 2 as well. So pick one of those, or one of the great thinkers. And I gave you, like Annie Duke, I gave you an entire presentation on hers. And with Caleb, I essentially summarized what he said. So it's putting in the own words, and you can quote Caleb in your answer if you like, but make sure you put it in your own words. Any questions on this one? You pick one of these 2, and of each one of these, you pick one of those in there. So looks like 20 things, but you're going to pick one of all those 20 things that you want to do. I always know who's going to do best in finance, because some students pick the easiest one to do. Some students pick the one that they think is going to impress me the most by their incredible, glorious answer. Those are the students that they're going to do really well.
So for case studies, we're trying to just look at the risks that were faced by the firms. For the thinkers, we're looking at their overall, what their thoughts on risk management are.
Yeah, so like Annie Duke, she said, what's the problem? What's the solution? So that works pretty well. Orange County, MG, long-term capital, all 3 of those are, give me the story, what happened, what were the risk problems that happened. Remember on long-term capital, I'll give you a whole list of what the risk, correlation, measurement of risk.
For problem 1, or I guess there would be problem 1, we have to pick 1 or 2, not previous. We have to pick 1 or 2 define measure mitigates.
You pick one of these, the big ones, one of these, the small ones.
Oh.
All right.
Yeah.
All right, did I answer your question? I tend to in class the one that I could really delve into the most, not the easiest one, but it just depends. It was strange at UT Austin, because UT Austin, they were strict. 10% A's, 20% B's, 30% C's, 40% D's and F's. You have a class of 30, you want to make an A, what do you have to do? You got to be in the top three. So I was like gunning for it every single class. And you probably won't believe this, but after an exam, they posted all the grades with social security numbers right on the door. You just went in there and looked for your social security number and you found it. So I was just always acing it to just destroy the curve as much as I could and get it as high as I could. I was a music major and an accounting major, and the music classes were far harder than the accounting classes. But still, the accounting had that stress of you had to be in the top three. We don't have that stress anymore. It's like everybody gets A's these days and B's. There's not many D's and F's. But you know, it's the goal is not the grade. The goal is the knowledge. So I would put I'm not giving you any stuff that's not valuable to know. All right, then the last part of it are the two math problems. So let's work a couple of those. The bond question is fairly straightforward. To give you a little bit of a discussion, a little bit of an essay, but not really very long. The math itself is pretty straightforward. So here you have, you're looking at the credit quality of banks. And we're looking at a BBB rated 10-year bank bond is paying 160 basis points. Is that an adequate spread? So if you buy a BBB bond to a bank, loaning money to a bank for 10 years, you're going to get 10-year treasuries plus 160 basis points. Down here is the default rate. And this also is well, this is in percent, the percent that default. So what percent of BBB bonds default cumulatively over 10 years? If you look at that line, it's 4.75% default, or 475 basis points. Does that mean 160 is inadequate? If 4.75% are in default and you're only getting 160, is that, so y'all remember how to break this up? What is this 160? How often do you get that? Every single year, right? You're getting 160 every year. Are 4.75% defaulting every year? That's the cumulative over 10 years. What percentage are defaulting every year? The 10, Bill Gates. So the 10-year cumulative default rate BBB bonds is 4.75%. The average annual default is what? 0.0475 divided by what? 10 or 47.5 bips. Remember, use bips in interviews. Sounds a lot fancier. 47. How much are you getting paid? Now, is even that, are you going to lose 47.5 basis points? What else are we missing here? That's the percentage of default. If a bond defaults, you lose 100% of your money. What else do you have in there? You have recovery rates. So around 30%. So it's 50%, 60% AAAs, 50% for double and single A, but about 30%. Recovery rate is about 30%. So average annual losses equal 47.5 times, is it times 30% or times 70%? Times 70, right? Because you're gonna recover 30%. So how much you're gonna lose? You're gonna lose 70%. That's 33.25 bips. You're getting paid 160 bips. So well compensated for what? For default risk. But there are other risks. What are those other risks? I don't know if I can remember all of them we talked about. We did this a couple of times. Double check your notes, but I don't know why I can't get the bar up here. Wait. Anyway, well. So you have liquidity risk. Corporate bonds are less liquid than treasuries. Anybody remember the other two I talked about? Correct all my typos. Talked about spread risk. Spreads gap in a recession. Price volatility be high. I can't remember if I gave you all three or four. Anybody looked in the notes, see what the other one is? What was the last one I gave you? Kind of a strange one. Relation risk. Spreads are correlated. Stocks. So in a recession, stocks are falling and spreads happening out. Both stocks, corporates struggling. There's probably some of that you got to compensate. In 2008, stocks fell 35%, corporates fell about 20%. Corporate bonds really didn't help you in 2008, but spreads gapped out so much in 2008. 2022, very different, right? 2022, stocks fell 20%, treasuries fell 20%. Why? Because of inflation. But in a recession environment, treasuries are going to do a whole lot better. In 2008, treasuries were up about 20%, corporates were down about 20%. You're probably gonna have to compensate investors a little bit more for that lack of correlation. Was there another one? I can't remember if there were. Anybody remember one? So if there's another one added in, I'll refresh my memory. How do I get the bar back? Anybody know? Right here? No. I don't know why Bill Gates would think I wouldn't want the bar, but anyway, I would do these as bullets if I could do bullets, but I can't do bullets. A pretty simple question. Do the math. Any questions on the math? So you just got to look at which credit quality I'm looking at. And this is absolutely true. And this is the reason when I started my job as an analyst, I bought that treasury and the head of the department got all mad at me. Why did you buy a treasury? Even though I bought it from my own personal account. And his quote was, "We don't buy treasuries at USAA." Why? Because in his opinion, you get paid for the risk. You buy corporates, but there is some argument for why. And this is my argument with the guy who wrote Random Walk Down Wall Street. He was showing bonds and how wonderful they were. He was showing treasuries. He wasn't showing corporates, but very few people buy treasuries in the investment world for like mutual funds and other things. So it's a little bit of a misnomer. So that's one of the lies we do. When we want to show diversification and risk management, we buy treasuries, but then corporates is what we actually buy in real life. So these are important points. So that's the whole of the answer right there. Oh, there we go. Can I do my bullets now? All right, everybody's good? Yeah.
I had a tailwords written down as well.
Huh?
You said, another list had tailwords written down. Tailwords?
Oh, terrorist. Oh, thanks. Yeah. All right, Bill Gates is not helping me here. That's kind of similar to the spread. It's just in an extreme case. All right, yeah, that's a good point. So four things. Anything else? If you could articulate this in an interview, you'd be in really good shape. The question they're going to ask you though is, how do you know it's a triple B bond and not a single A bond? And that's where you do your financial analysis, your ratio analysis, all those things that you learn in your corporate finance classes. All right, so then we have this question. This is the one where you got to do that weight squared, risk squared. Why am I making you do all those calculations? Because y'all proven me that you've forgotten that formula. And if I force you to study for an exam and then write an exam over and over, maybe it'll stick with you. It's maybe one of the single most important formulas in finance because we use it all the time to manage trillions of dollars. So it's a pretty important formula to know if you're a finance major. So it's a $670 million managed futures fund. You don't have to worry about that, but that's what it is. It's a fund. Your boss is looking for which fund to add. You're looking between A and B. You're going to put 20% in your portfolio in one of those two. So you're going to either do 80% current and 20% A or 80% current and 20% B. You're trying to figure out which of those is better. Your risk tolerance, 0.6%. Let's get that out of the way. What table value do we use for 0.6%? So what are you looking for? You're looking for is it this 0.6? You don't even see one, right? So it can't be the outside side. So what are we looking? There's no 0.6 in here. So what are we looking for? 99 what? 99.4. There it is right there. So what kind of event we're looking for? A 2.51. Right? Get that out of the way right up front. So you don't have to just get out of the way so you can put that piece of paper away. All right, so let's look at the actual math here. I'm going to do it in Excel. I wish y'all could do the exam in Excel, but it would be a much harder question because it asks you to do some optimization and some other things too. In fact, if we could do this in Excel, I'd probably just have you build an efficient frontier in Excel from scratch. There's a class being offered this summer. I don't know if any of y'all are graduating. I was going to mention, if you're graduating and you didn't hate this class, come take a selfie with me because I'm going to try to flood my Facebook with all my graduating seniors. I've already gotten 2 pictures already, which is amazing. That's 2 students. I kind of guilted them taking the pictures, so they're probably regretting, but anyway, I got them to take a picture. All right. So let's see if we can. So the portfolio is 670. You can just round everything. That's perfectly fine. You don't have to go out massive amounts. Our target is 80% current and 20% either A or B. In real life, you might do A and B, some of each, but we're just going to limit yourself to one or the other. Our value at risk. She says the current level is 91. Now that can help you because you're going to actually calculate that. And if you get 47 or 128, you probably have a math error somewhere. So we can start with what is the current value at risk? And then your target value at risk is 75. So you'd want to know that. So your boss has expressed to reduce the value at risk below 75, well below the current level 91 by adding a new manager and return target equal or higher than today's. That's not always the case. There are times where people actually say we're okay with the lower return if we can significantly reduce the risk, but usually if you have a hedge fund, you want to keep that target return at some level. So that's everything in the targets in the discussion that we need to know. So let's put, obviously doing this in Excel looks a lot different than you do it by paper. So your current has an expected return 4.5%. Strategy A, 465, strategy B. So which between A and B would meet your return desires? I mean, current return or better? Which of them will give you the current return or better if you add them? They both will, won't they? As long, remember, return's real simple. It's just 80% of 4.5% plus 20% of the other. So both of them are going to give you a higher return. So that's not going to be an issue. And then we have expected risk, 7.2, 16, and 5.4. And here I was probably trying to trick you a little bit. Because, you know, on the previous problems, hey, whichever one had the higher standard deviation and negative correlation, that's the one. But that's a pretty high standard deviation. So you have to kind of ask. Remember in the formula, you're squaring risk, but you're also multiplying at the end by the negative 0.1, but then you're only using risk once. So is this 16% going to more than offset the 10 basis point there? So here we have the correlation of negative 0.1 and 0.4. Someone was asking about the 1. You can ignore the 1. We don't need that. Obviously, the current portfolio is correlated to itself. It's the same thing. All right, so you see where we're going, putting all the numbers down. Any questions up to there? Now what I would do is I would do the expected return combined. Current 20%. So the expected return is just going to be 80% of the current return plus 20% times A. That should give you 458 or so. 450. That's not, oh, 20%. I'm sorry, I did 50-50. 453. Same thing with this one. You do 80% times the current, that's 20% speed. So expected return is real simple. They both are going to increase your return a little bit. You might say, well, B's better. Yeah, we're talking 1 basis point. Do we know for sure their expected return is exactly 4.7%, not 4.68 or 4.71? You know, so we're a little bit overly precise. Remember what Aristotle said, you know, your solution shouldn't have more precision than the question allows. So, you know, that's pretty close. So either one of these would work. It's pretty close. And then let's look at the VAR. I'm going to calculate the VAR for the current because I want to make sure I'm getting close to that 91. Does anyone remember the formula for VAR? Before that, you start off with the mean, yes. And then what you said, Carson? Times the sigma, the risk tolerance. So yeah, you'll have that. You'll need that formula. So we take the mean minus, what was the number of standard deviations? 2.51, is that right? Times your standard deviation. And that gives us 13%. Let's do the VAR in dollars. So that times the portfolio, 13. Does that look like we're pretty close on the 91? That looks pretty good, right? So look, that gives you some confidence, right? If you got 120 or you got 60, you probably did something wrong. All right, so can y'all do this? What's the VAR for this? So before we can do that, we actually have to get, so before you have to do that, you have to do the standard deviation. What is this, to get the VAR, we need a standard deviation, right? So you gotta calculate, what's the standard deviation? This is the question y'all keep depressing me on, but tonight, no, because the exam's only a week away and y'all gonna all ace this. What's the standard deviation of A and B? I mean, current and A. Throw out the numbers.
0.8 squared.
0.8 times 0.8, right?
Weight times risk times point.
Weight times what? What's the risk for current?
That's 7.2.
Do you square or just multiply it once? Risk times risk. Is it times, plus, minus, plus, and then what do you do next?
2 times.
0.2.
Oh, 20%.
Well, I am squaring. 0.8 times 0.8 is squaring.
Are you laying it out differently? Because I thought it was. Because you're using the weight twice.
I'm squaring it. If y'all want me to square it, I can square it. I don't wanna, it's just easier for me to do it like this. Right, that is squaring it. Then you're gonna plus, and then what are you gonna multiply next? 0.2 times what? Times what? 16.
Times 0.2.
All right, plus 2. All right, you know what's the last thing you gotta do? Take the square root of that. You need to practice this on your calculators. It's a lot easier to do this in Excel than a calculator. Should you memorize this formula? Absolutely not. You should know this formula. If you are a finance major, you don't know this formula, you should tell them you went to A&M. This is such a central formula to finance. It's an amazing, important formula in finance. So the weight squared, 0.8 times 0.8, times the risk squared, plus the next weight, 2 times 2, 0.2 times 0.2 times its risk, plus 2, you gotta remember that 2 in there, 2 times the weight times of A, current times of A times their risk times the correlation. Take the square root of that whole thing. Now, what are you expecting this number to be? Well, current is going to dominate because it's 80% and it's 7.2%. It's hard, you think about it, we're multiplying that 16 twice at the beginning. Multiplying twice actually makes it smaller, but we're multiplying that 16. And then we're going to take that 16% and multiply it out once and then multiply it by -1. So you're kind of asking which has the bigger impact, this -1 or this big 0.16 there. And you can see it actually reduces the risk quite dramatically. Did y'all get that number, anybody? Those that did it, does that look right? Or no one tried it?
I got that.
Did you? All right, good. All right, 6 point, so it actually brought the risk down. So it looks, but to me, it's not always obvious. If the risk were 80%, I can't do that. I didn't reference it, but if the risk was 80%, who knows? So don't just assume you see that negative correlation. I'll probably try my hardest to find one where the negative correlation isn't the answer. I don't know. But don't just assume that it is. But here it's pretty incredible. But here the risk is much lower, but there's higher correlation. And what you notice is risk of B is lower even than the combined, even with that -0.1. So it's possible B could be lower. So you got to do the math. All right. All right. So someone help me on this one. Y'all, I just want to know y'all know it. So yell it out, humor me. Plus, make sure you plus. Some students do multiplier all the way across and they get a really bizarre answer and it's just, they know it can't be right. All right, then what's next? Not, this is B. This is plus times plus. Well, I do weight times weight, but. 0.4, yeah, 0.4. And then make sure you take the square root of it in. Are y'all getting that in your calculator, right? You gotta make sure you have your calculator. In your calculator, you might write everything in parentheses and then take the square root. And it's really close, isn't it? So here I actually did work it out that the negative correlation wasn't the right answer. So it is possible. All right, then we got to calculate the VAR. What is the VAR? You take the mean minus 2.51 times the standard deviation. All right, you remember that? Use that formula again. And what is that in dollars? You take that times 670. What was her goal? 75, that doesn't quite do it. Here we do the same thing. We take the mean minus 2.51 times the standard deviation. Take that, multiply it by 670. Did she say she wanted to be below 75 or did she say around 75? I can't remember what she said. She says 2 below, I probably meant 2 or below 75. So it's close, unless I have a math error somewhere. It's pretty close. Anybody can confirm these numbers by any chance? That's close enough. Pretty close to 75. If you round, you'll take out the decimals, you get the numbers. If we take out the decimals, it works really, really well. All right, so this is a big part of the question, is just getting these numbers. Problem students have is they mess up the math and now they can't answer B because they have all bad numbers. So you really need to get the math correct. So practice it. It is doing these things over and over again. So the formulas you need are what is the VAR? The mean minus the number of standard deviations, or the number of standard deviations times the standard deviation. Did I write that correctly over here? No, I did that wrong. It's the standard deviations times I said this backwards. It's the sigma times the standard deviation. So your number of standard deviations minus 2.51 times your standard deviation. You need that, and then you need standard deviation of a portfolio, which equals weight current times weight current times standard deviation current standard deviation current plus, then you do that entire thing again for A plus 2 weight current weight A deviation current times A times correlation A. Take the square root of that.
So what is that formula essentially broken down into?
Well, we talked last class that it's, if you remember your college algebra, or even before, it's just a full formula. If correlation is 1 and you unfold this, you end up that the risk of portfolios is the weight of current times its risk plus the weight of A times its risk. There is no risk reduction. But then as the correlation falls, this part of the equation is going to reduce the risks because this number is smaller. So your risk will always be lower than the weighted average of the two. Whereas your return is always the weighted average of the two. So return stays up there where your risk comes down, and that's the power of the correlation. So if you think high school algebra, it really is, it's the unfolding of that formula. That's why it's at 2 times the weight at the end. I've probably used this formula, I don't know how many thousands of times in my career. It's pretty important formula. So those are the two formulas you need to know. If you got those down, you've got the problem. It's just a matter of working them through. Any other questions on this? I'll put this Excel out there on. And the first question is this straightforward. I don't throw any kind of confusing points on that one. The second question is also the same. All you got to do is graph this. So you just have to see how she wanted it graphed. So which do you recommend and why? And this one's pretty straightforward. Recommend B because return is higher and bar is very close to the 75 target. Pretty straightforward. Now, if you want to argue that, well, they're both pretty close to 75, but well, B has the higher return. I guess that's the other argument. Current and 80% current, 20%. Okay, I mean, you want to argue that the 540, 440, 454 is higher than the 453. You could add that, but just look at what she was asking for: the same or higher return and below the bar. Now, if both of them are, and I won't give you a question like that, but if both of them came in below, yeah, you would probably go with the one with the higher return. Would be pretty straightforward. What if one's 40 and this one's minus 16? I'm not going to give you those kind of questions, but then there is a place where you're somewhat comparing the return versus the risk. I'm not giving you that, but often that is the decision you have to make. All right, and then the thing is, you just graph it. Spend some time on the graph. I get some graphs that they're not even readable. I can't even tell what they drew.
Would it be worth calculating bar with a correlation that's something that's not inside of the portfolio? Like if you have like asset one that's correlated with something that you calculated the correlation with, say like commodity instead.
Well, these correlations will change. So that's the environment argument. This is one number, but this changes the environment. So I don't know if I'd recalculate it, but you might want to say, hey, when inflation's high, this correlation goes to 0.6. When inflation's low, it's negative 0.1. When inflation rises, its correlation actually drops down to 0.1. That would be information. There's no way to do it in the math because you have a moving. This formula assumes one number. But yeah, you would definitely say, hey, in a crisis, A does great, but in a crisis, boy, it doesn't look so good. Or in an inflationary period, so our commodity prices, B really does well when commodity prices are taking off. You can definitely do that. What factors you look at, every factor you can also think of that your firm cares about. You can't put it in this summary, but for something like this where it's so close, you might say, well, we have an exposure to oil prices, and A does a whole lot better when oil prices are falling. So, and we need oil prices to be rising. So, even though A is slightly worse, in the one scenario where we really do badly, A does better. So let's pick A. So yeah, you could certainly put that analysis in there. Your challenge is going to be that A and B probably only have about 6 years of data. And you have to say, when's the last time oil prices really soared? And you might not find a period in that time. Anything like that, you can add value to it. So I'm simplifying it here. So how are you going to graph it? Well, look at how your boss said to graph it. Graph the current portfolio. You want to show the 3 points: current with A, current with B. You have 3 points to show. You're going to put risk on the Y. You're going to put return on the X. And how does she want to do it? She wants you to use VAR in dollars as your measure of risk. So you can have a graph. I don't know if I can show the graph here. You're going to draw it by hand, but you want something that looks something like this. Oh my word, why did you do that? I don't, Bill Gates. I don't know why it He thought I wanted that. Yeah, and he's still doing that. So Bill Gates is not helping me tonight. But you want your axis on the left side. I guess I can go tell it. Right. So, and you want to spread it out. And remember, when we do VAR, you want to show it as a positive number. So I should have done that. And then we don't need it way over there, so I'm going to change, when you draw it, it's a lot easier to draw because you don't have to deal with Bill Gates. But I might start it at 70, like that. So that looks pretty good. That's a pretty good graph. And then just label them. So this is with B, this is with A, and this is current. You want to put some line in. She wanted. Yeah, okay. So Bill Gates is watching, so I can't do anything. But anyway, if you want to put a line, you could put a line in at 75. You could put a line at 450 because you want to be above 450. You want to be to the left of 75. You want to mark those points. But some graph, you might bring a ruler or something. And then before you start drawing, think about where you want the bottom and the top of the graph to be. So, yeah, I remember our real estate company, my word, they wanted to prove that it really didn't make a difference. And so they formatted their axis. And they say, yeah, they're all about the same. Yeah, that you need to change your axis to something besides that. That doesn't make sense. I don't want to yeah, I guess I can reset that one. All right, so draw the graph, make it sure it's easy to read, it's clear. And then the last question to get a little bit tricky, you're able to get simulation results from both managers. You want to see a more sophisticated simulation model will give you less confidence than recommended. You've run 10,000 simulations. Do you think the results strengthen or weaken? So these are simulations of your managers. And you've run the models with 80% and 20%. Your parametric gave you VARs of 76 and 75. What does these stochastic? Right, so these are the losses, but which one of these is the VAR for this company? So those are my property casualty class. They remember this. So which simulation do you use? It's going to be the number of simulations minus the number of simulations times your risk tolerance plus 1. That's the simulation you're looking for. In this case, we have 10,000 simulations. Our risk tolerance is 0.006 plus 1. So we're looking for simulation 9941. There it is right there. So we get minus 77.223 minus 63.279. Everybody see where I'm getting these numbers? This graph. We ran 10,000 simulations. The one that is our 0.6 probability, 0.6% probability is the 0.6% from that last simulation. So we've ran 10,000. We take 10,000 minus our probability, 0.06 times 10,000. But we add one. Why do we add one? Because we're counting 10,000 as one of ours. All right. That gives you simulation 9941, 9941. Here's the value. Here's the losses. That loss at that simulation level, that is your value at risk using stochastic. That's exactly what we did at USAA. You probably think it can't possibly be that simple, but USA would run 1 million hurricanes, earthquakes, whatever's. Our risk tolerance was 0.002. So if we ran 1 million simulations, they would take 1 million minus 1 million times 0.002 plus 1. And they would go find the simulation. They list them all from number 1 all the way to 1 million. 1 million was the worst case. They list them all. They go find number 998,001. That was our value at risk. So it seems like it can't possibly be that simple, but it was. Now they would look at the other simulations. They always looked at the worst one. They were just curious. And some of those were really scary, like Hurricane Sandy. I remember that. Hurricane Sandy, a couple of miles further north or south would have been a massive, massive, massive event. They had one scenario where the entire state of Hawaii disappeared. It only showed up once in their simulations, but like Hawaii doesn't get hurricanes very often, but if it gets one, it could wipe out the entire state. That's kind of scary. So you can look at this one. That's pretty huge, right? 150, 126, that's pretty huge. But with value at risk, we only care about the one that happens 0.6% of the time or more frequently. Anything happens less often than 0.6, we're going to ignore that. So what does this tell you about your analysis? You're recommending B, right? Does this weaken your analysis or does this strengthen it? Are you more confident in B now or less confident? Looks more confident, doesn't it? So if anything, if you use a more sophisticated model, B actually looks even less risky. A looks about the same, but B looks, why? Mainly probably to Tristan's point. It might be that in the scenarios where our current's doing badly, B actually does pretty well. And so they actually offset each other, and that may be the reason why the sophisticated modeling actually works well. So maybe we did cover this, Tristan, by doing the stochastic analysis, which should cover exactly what you're worried about. Most students get the first question pretty well. The graphs are all over the place. And a lot of students just leave the last question blank. It probably will be a stochastic problem where I'll give you simulations. You just have to know that formula, pretty simple formula. All right, any questions on that? I'll save this to this. Maybe what I'll do is I might find one more question and maybe work it on a Zoom session, maybe on Tuesday or something. If y'all want one more practice problem, or y'all get this down. Now, don't say you need it again because you can't remember weight squared times risk squared plus weight squared plus that. You just got to know. You just got to learn it.
Did you add it as a bonus?
Yeah, I don't do bonuses because that means more grading for me. So I like to sleep some of my life. So no. All right. No questions. All right. Let me finish. Let me give you the last part of what I want to do. I get a little preachy here, but I won't try not to. The first thing I was thinking of, if I were you, what are the black swans I think you might see in your lifetime? You might say, what good are we at black swans? 2008, we were talking about the subprime. So we were talking about it before it happened. In 1999, we were talking about the .com before it happened. So that was pretty good. George W. Bush was talking about pandemics during his presidency. So we were talking about pandemics. I don't know about before World War I and World War II, if they were talking about that. We were certainly worried about Germany and Nazism and all that. There were talks. So it's possible the biggest black swan in your career is something no one's talking about right now. That's certainly possible. But could we have a world war? So China and Taiwan, to me, is the biggest risk. I saw an article today that Russia's retooling. I have trouble believing Putin would be stupid enough to attack Finland, given how many of his people have died, but who knows? He's a crazy guy. Who knows what's going on in the Middle East and what's going to happen between Iran and Saudi Arabia and Iraq and all these countries. Who knows what will happen there, and Israel in the mix. Who knows what Kim's going to do in North Korea. I don't know what other spots there are. Cuba's kind of settled down. Venezuela, I can imagine he would do anything, but something could happen. You know, I gave you some old cases, but your history classes are pretty important to understand what happened in World War I, World War II, and understand how does a world suddenly start throwing bombs and missiles at each other. I do think government debt crisis is a big one. What could that lead to? Well, one or two things. Here's where I really recommend you read Lacey Hunt's, and I haven't read his last one yet. Does all this massive debt, is it hyperinflationary or is it deflationary and recessionary? He's more in the later camp, that all this inflation is essentially the whole world is going to look like Japan did during its doldrums. It's just going to be incredibly slow growth. Why would it be hyperinflation? Well, what's the one way a government solves its debt crisis? It monetarizes it and causes massive inflation. There are people proposing that our government should just start shooting for a 5% inflation so we can get this debt off the books. The problem with this is we still have these massive deficits, so you can't really do that until you get the deficits off. Otherwise, it just keeps growing. Political risk. I was reading an article. Support for democracy. That more and more people in the Americas are thinking democracy is not the way to go. That's kind of scary. Give us a military leader so we can solve all our problems. You've kind of seen that somewhat in El Salvador. Solve our crime problem and we'll give you all the power you want, kind of thing. That's kind of scary. I'm in the incompetence. It's amazing to me how our political system, I think it's just so horrible that really competent people just aren't going to run, because who would go through that mess? And I think you may not agree with that, but I just don't get excited every election season. Climate change is obviously big. If you're not a big proponent of that, there are some great books out there that I read that talk about the impact of our response, whether climate change is there or not, the things we're doing. So there's all kinds of things going on there. I think that's going to be pretty touchy. The deterioration of Earth systems, I've seen both sides on that, but we've seen our coral is getting destroyed, getting bleached out. There is a lot of concern about water. I think right now India is cutting off water to Pakistan. That's really nice for two countries with nuclear warheads. That's kind of nice to do. Pollution is a smaller risk today than when I was in the 70s. That's all we talked about. So we've somewhat cleaned up our world. Biodiversity, ecosystem collapse, natural resources shortages. There's all these kind of things. There are people talking about fish stock in the world, that we're overusing our soil, that all these kind of things. Who knows if one of those would prop up. Shrinking populations and falling birth rates. You think these two would go in opposite directions, right? If we have fewer people, we wouldn't have this problem, but that's one people are talking about. China's begging people to have babies. Japan's given up getting people to have babies, and Japanese are not having kids. Japanese your age is like, I'm going to live alone the rest of my life and be happy about it because I just can't take this pressure anymore. So Japan is just shrinking. Space events, these come out of nowhere. But a solar event, an asteroid, I'm not that worried about an alien invasion, but those are ones that could certainly. We saw that big asteroid hit in Russia, and that was kind of scary to see. So that could be there. Obviously, pandemics are still going to be there. I was reading an article about how quickly certain viruses are mutating. We were talking about tuberculosis, which is a major, probably the leading killer, and y'all know it's like the leading killer in the world is tuberculosis. And the problem with tuberculosis is it takes repeated treatments. We know in Costa Rica, this is an issue. You have someone with tuberculosis, they got to walk 16 hours for a treatment. There's a good chance they won't come for the second one. What does the first treatment do? It starts the mutations. And so if they don't get the treatment, then you have a whole new strain. So that is certainly scary.
that'll probably kill me and it kill you, but I've got 40 years on y'all, so y'all are losing a lot more than I would, but who knows what's gonna happen there. There's some bird flu or something going around, right? Y'all read these articles. I see them on TikTok. They have this scientist and they're like, yeah, I'm scared of this. This is terrible. You know, they know how to sell the TikTok. Some terrorist attack, especially with nuclear warhead. Some cyber attacks could certainly be there. I think there are probably people worried about a massive cyber attack. Artificial intelligence, who knows what that's going to do? People say, if you look at the predictions, there's a higher percentage that say that's going to kill us than global warming. But no one really knows how it's going to kill us. So that's kind of the interesting one. I do think it's going to hit us on this number 12. Polarization in the deep fake world, where we can't trust anything we read. And we have AI out there figuring out how to trick us in a lot smarter ways. And who knows what this is going to be. I don't know what your generation is going to do with this. I'm still amazed what people believe when they see it on Facebook. So y'all need to do what Annie Duke said, is start putting that want to bet on there. You want to bet? I'll bet you $100. That's not true. Let's look it up. But we're going to stop believing anything we see, and we're going to kind of rely on a tribe. And then this one I think is huge. I think dopamine addiction is huge. I was watching a TikTok, kind of ironically watching a TikTok. High school students spending 15, 16 hours a day scrolling. I saw a high school teacher, she said, I've given up. They're all zombies. They can't think. They can't sit there for more than 4 minutes. People in my classes can't make it 75 minutes without checking their social media. That's going to actually destroy you. I think you got to figure out something. One of our former students, she's developing a software to help us with this addiction. But what happens with artificial intelligence when it's told to make us more addictive? How good of a job is it going to do? It's watching all of our scrolling. Is it going to do a good job of addicting us even more? And how do you get around from that? I don't know, but I would be really worried about that for yourselves. What's the longest you've gone without checking social media? Can you make it 5 minutes? And it's not just your generation. I spoke at a Bloomberg conference, and I told some of you this story, but one of the speakers, I was one of the earlier speakers, she was the last speaker, and I go, man, cell phone use in class is such a pain. It's so disrespectful to professors, but students still do it. They just don't care. And she says, yeah, that's horrible. That's horrible. And then guess what she did that entire day? She was on her phone constantly, and during my presentation as well. And then she went up and presented. I was tempted to take mine out and just go like that in front of her. I had mine turned off, and then the satchel. Most people in the room did. Most people were really respectful. She wasn't 20 years old. She was old like me. But she didn't care about my presentation. She didn't care about anybody's presentation. And I was like, I didn't really care about hers when she went up to present it. But that's where we are. We're so addicted that we don't care how disrespectful we are to people speaking. And I've just gotten to the point where if someone's speaking, I'm putting my phone away. It's just terrible. But we've got so many, I call them smartphone zombies. And I think some of them are so far past any recovery. I asked someone once in class, is there any salvation for zombies? Because I don't watch the zombies movies. And she said, love. Love is the only solution. And I said, there's no love in finance. So we're hopeless. It's not going to happen. But if you're a smartphone zombie, you're probably done for. It's probably your career is over. You can't. What does it do? It so dumbs down the brain. We think we're multitasking, but for the brain to multitask, it has to cut out a lot of depth. And it just makes it stupider and stupider and stupider. And that was part of the issue we're seeing here is innovation's declining, creativity's declining, and it's a disaster. If I were you, I would find some way to limit myself. So Cam Newport, I think, is a really good one to listen to. What does he say? Deep Work. This is his book. I would read that book, and I would find ways to fix this, or you're going to be destroying your career pretty horribly. Which brings me to, so I talked to Krista tonight, and I was asking how she's doing. She works for this firm, primarily, really tough term. I want to see how she's doing. She's a really sharp student, so I knew she's probably doing pretty well. And so, where are you? How are you doing? She says, I'm director of, I was like, wait, you're a director already? And sure enough, there she is. Any of y'all know Carissa? You're welcome to LinkedIn with her. She says, oh, I'll talk to your students anytime. But she's already a director. She's a director of project finance. She was a biology major and she took one of my classes and somehow corrupted her and she switched to finance. But she's doing really, really great. She's at a solar firm, doing both solar and batteries. And she's in charge of financing these multi-million-dollar projects. And so I talked to her about my list on how students can avoid being fragile. And or even before I told her what my list was, she was actually on my list already. So here's what I would suggest. This is my last. Use system one. How do you become fragile? Use system one thinking when you should be using system two. Remember Annie Duke's time travel? Stop, put yourself in the future, because remember, your mind is overly optimistic. It exaggerates pleasure, exaggerates pain. It gets you to go to HEB and buy Oreos when you know it's a waste of time and money. System one, I mean, you're making some of your biggest decisions, whom you're going to marry, how many kids you're going to have, where you're going to work. You better be using system two thinking that marriage is really risky. Staying single is really risky. Having kids is really risky. Not having kids is really risky. But you better think long and hard about it. What careers you're going to do, extremely important. This is a huge one, but not for the students I've been talking to. They've been really, really good. The alums, missing out on a positive black swan because you're scared. Fear should drive you to make a decision rather than prevent you from one. A lot of students, they settle into the easy job. I know students 6 months out of college and they're indispensable. If any of y'all are indispensable 6 months out, you've got a really bad boss. Your boss doesn't scare you to death for at least 3 years. You're working for the wrong boss. You need to get out of that job. But I know students, like one of the students, the first student I hired right out of my class, great student. He moved up and went over to procurement and other places. He wanted this new job. They wouldn't let him do it because he's indispensable. It's like, that's not because you're great. It's because people you're working for are just not doing their job. He had to quit UTSA for 6 months and come back to get the job he wanted because they wouldn't let him move. So fear of radical change because the current state's so comfortable. And then choosing monotony, you know what it is. It's ridiculous. You like it. The great opportunity comes along, you don't take it. That is a huge mistake in your, especially right out of college. Debt is a huge killer, especially if you're playing a comparison game. If you're buying something to impress people, you're done for. You know, we buy fancy cars so that our friends will hate us. They can hate you for other reasons. Don't buy the fancy car, all right? They're not going to be impressed. They're just going to be jealous. And why do that? So keep debt. If you can keep debt out of your life, that's going to help you when, like with Carissa, she started working for this somewhat of a startup firm. If she'd have massive mortgages on car payments, she couldn't have done that. She would have. So, you know, I wish when I got out of college, I went and found Steve Jobs and say, I'll be your CFO. You can pay me minimum wage, whatever. You know, you can't do that when you have a mortgage and you have payments. So keep yourself free. You've got to find your specialization early. That's the one thing I'm definitely seeing from all of our alums. The most successful ones, they took a big risk, they jumped into it, and they learned it backwards and forwards. Like Carissa, she understands her market extremely well. She's negotiating $100 million, $200 million deals. She knows what she's doing. She knows the jargon. She used some jargon I didn't know. It's like, what are you talking about? She's in a very, very good spot. There's very few people in the world that know what she knows. And so she's set. So you got to find that special. You can't be jumping around. I'm going to do utilities. Oh, now I'm going to do auto industry. Oh, I'm going to go over and do some biomedical. You've got to find that specialty early and find it. You've got to be learning continuously. And that's one thing she really emphasizes. I got to learn. I got to learn. I got to learn. You said that's why I don't understand students that don't come to class. They're stuck on social media the whole class. If I were you, I'd be so desperate to learn every single smidgen of thing I could learn in and outside of class, Because you're walking into a competitive environment that is unlike anything I saw. When I graduated from college, the top 25% and bottom 25% were about that close together. Maybe the Grand Canyon. Now it's more like the Pacific Ocean. The top 25% are off the charts better than anyone in my class. Bottom 25% are smartphone zombies. They just walk around like this constantly. One Halloween, I actually did a picture. I had all my students on their phones as zombies, and I was like the professor killing smartphone zombies. That was my Halloween outfit for that year. But learn continuously. New innovations. The world is changing fast. It was so easy when I graduated from college. It was learn Excel. That was it. Learn Excel. And we did. We learned Excel better than the next generation. So they all felt like we were pushing them out. The people that are 10 years older than us, we were crushing them. We're taking their jobs. We're pushing them out. That's all we had to know. Your list is really long. So that's why you should be desperate to learn this stuff. If you're not learning constantly every day, the physical side is really important. People think like excessive on exercise, but this is the existentialist part of me. You only get one life, you only get one body, and every single thing you do in this life, you're going to do in this one body. So the physical side, exercise, diet, stress management, sleep, I'll make that a big part of your life. And I would combine it with this one. I'm 3.5 hours every day on a bike, listening to The Economist, listening to podcasts, listening to books, talking to former students, whatever I can do. I would combine those two. You've got a Zoom meeting every morning. Get on your phone with the Zoom meeting and go walk up and down the stairs. When I studied for the CFA exam, when I was at USAA, I took all my notes and I just started climbing all the stairs at USAA in the morning from like 6 to 7 o'clock. One lady yelled at me, "You should be walking while you're reading." I was like, "I don't care. I'm studying for exams. So, let the naysayers say what they're going to say." But figure that out. You got to figure that out. I know people my age that can't do anything because they're out of shape. I go to Costa Rica and they can't do it. I just can't, I have relatives that they can't do anything because they're just so out of shape. You can't do that. You're going to be sitting at a desk job where you're going to be thinking most of the day, you better be moving around. Focus on income over wealth and wealth over a positive impact. This is what Krista says. She picked a job that she really believes in, and she loves it. She feels like she's changing the world. I saw this in a book. Pushing your resume at the expense of your eulogy. At some point, you got to ask, what's my legacy? What did I leave behind? What are people going to say when I die? You may not care, but you should care. And then the last one, boy, I have 3 minutes. Don't leave yet. Hear me. How many enter your life and discovering you never lived? So here, I'm going to maybe depress you a little bit. But I read this book, maybe a little older than you. Have y'all read this, the Toy Story? The Death of Ivan Illich. And spoiler alert, he dies at the end. But this is an incredible book when I read it. Toy Story, this is his shortest novel. You can read it in a couple of days. But this guy, Ivan Illich, he's doing exactly what he's supposed to do, conventional life, moving up. And then he has a small fall and he hurts something inside and he starts dying slowly. And at the end of his life, he starts asking these questions. He has this conversation with his soul. Why does all this happen? What brought me here? And then he asked the question, and this is kind of the part that I think is pretty crushing. He tells his soul says, "What do you want? What do you want?" He says, "I want everything back before I fell." And his soul says, "Well, how was that?" And he goes, "Well, it actually wasn't really good. Other than my childhood, I've kind of been wasting my life." So he kind of figured out he was in pretty bad shape and didn't know it. It's a pretty depressing book. So he went to school. He was having a child. Went to school. That was kind of nice. There were some friends there. That was kind of nice. Then he started his career. Some pleasant moments. He fell in love. Got married. Don't read Toy Story on marriage. Those getting married, don't read his books on marriage. They're pretty depressing. He had a pretty horrible marriage, and he's pretty negative on it. But then that deadly official life and those preoccupations about money, 10, it is as if I've been going downhill and I imagine was going up. It can't be life. It's so senseless and horrible. So essentially what he's saying is I did exactly what everybody expected, and then I discovered I didn't do anything. I love what Krista did. She said, I'm gonna have a positive impact in this world. I'm gonna change careers if I have to. you're walking into a career in finance, got 1 minute, where there are a lot of jobs that are completely useless other than making you money. You may have to take that your first job, but after 2 or 3 years, you better sit down and think, what are you going to tell your granddaughter when she's sitting on your lap in 40 years? It's like, I was really good, man. I ripped off these senior citizens. They didn't know how bad the product was, but boy, we charged them so much. You should see me. I was one of the best salesmen of these horrible overpriced products. Boy, is that what you want to tell your granddaughter at the end? So you should read this book. But anyway, make your life count, make it meaningful. Benjamin?
Pretty sure about title of book.
Yeah, it's the death of, just do the death of I with Tolstoy and it will come up. I'm your professor for life. If you're graduating, you can call me anytime. I'll probably be calling you 2 or 3 years from now. So I want you to succeed, but I want you to succeed. My definition of success is not that you're wealthy. My definition of success is that you're radically changing the world to make it better. All right. If you do that, I'll be happy. And that's what our alums are doing. It's pretty amazing. So, all right. So if anyone wants to give me a selfie tonight or at the final, let me know. But anyway, I'm done.